Welcome to the BankTalk podcast, the show where we talk to leaders and experts from the community banking sector. Whether you are a current CEO or aspire to be one, this podcast will give you valuable insights and advice on how to run your financial institution better. Each episode explores a new topic with a guest who brings their unique experience and knowledge. Tune in and discover something new each time you listen.
Hi, and welcome to Bank Talk. I'm Charlie Kelly, your host and partner at Remedy Consulting. Today, we are going to talk to Ken Hagland and Bo Herdig from Ballard Spahr, LLP. They're a law firm. We bumped into these guys at the Acquire or Be Acquired conference. Generally, when we attend conferences like these, the Remedy team attends them, we generally will look over the sessions. Each of us sort of split up and go our own way and try to decide if the presentation is a sort of a veiled sales pitch, or if there's material in there that you can use and learn something from. So we attended this interesting session with Ballard Spahr. They effectively had a list that they put together of things to think about as you're preparing to do a merger and acquisition. And specifically, they had both buyer and seller side of the equation in their notes. But I always thought to myself, first of all, who doesn't like a good list? So that was appealing to me. And then secondly, I thought, boy, if we're going to try to bring some of this out in a podcast, can we do it? Can we narrow a 1 hour presentation down to a 20-minute podcast? And I wasn't sure if we could pull it off. So that's what we're going to try today. We decided, in order to sort of narrow the topic a little bit, we're going to try just the buy side. So, what advice do these guys have for somebody who is potentially going to be a buyer of a community bank? What's the checklist look like? What things should you be thinking about? What do you have to prep for? Which of them happened during the transaction, that type of thing. So without further ado, let's get to Ken Hagland and Bo Herdig from Ballard Spahr and see where this takes us. Okay, welcome back to Bank Talk. Said in the preamp, I've got Bo Herdig and Kenny Hagland from Ballard Spahr. Thanks for joining me, guys.
Thank you for having us.
Thanks for having us, Charlie.
If you would, give us just a quick background, one of the two of you, please. Who is Ballard Spahr, and where do you fit in that ecosystem?
Yeah, I can do this. Again, Bo Herdig, and I'm based in our Minneapolis office. So I serve a lot of our Midwestern clients, Minnesota, Iowa, the Dakotas, Wisconsin, some in Illinois. But we also have a national footprint at Ballard Spahr. And since a lot of banking laws are federal and a lot of the state statutes have similar themes, we actually help clients in a number of states nationwide with all kinds of interesting projects. We do have a banking practice. We have consumer financial service practices. I focus on banking M&A, bank regulatory, bank corporate type matters. And Kenny, do you want to maybe give a couple words on your area?
Yeah, absolutely. So Kenny Hagland, I'm a partner in the Portland, Oregon office. I'm co-chair of the M&A practice at Ballard Spahr across the national platform and our 19 offices. We have about 90 M&A and transactional attorneys on that team. And I have spent almost 2 decades working with banks, community banks and regional banks, and really happy to be here. Thanks, Charlie, for having us.
Great. Yeah, I caught a little bit of your consumer finance podcast. Just listened to an episode or two. It's pretty interesting stuff. So really appreciate it. At least the firm somewhere has got some experience doing these podcast things. So, guys, thank you for joining me. Here's what I thought we would cover today. I introduced the audience to the fact that we had met at Acquire or Be Acquired. A lot of times you weed through these things and the presentation is half self-promotion. I think you guys did a really good job of carving that out and really just having a list of things that, if you're going to be proactive, either on the buy side or the sell side of an acquisition. When you guys did the presentation, I kind of walked away with the feeling that, if you had a wish list of how to get a client prepared, so when they walk into your office, they're already there. That's kind of the feeling I got about your list. So I thought we'd try to handle buy side today. If it turns out that we can get some conversation going on the sell side, if there's enough left after we get through this, then we can talk about a future podcast. But today I just wanted to kind of talk about how do we get somebody prepped for being a buyer. So part of the conversation that was in some of your slides was, why do you want to be a buyer? I wanted to start, I thought it might be good to start with the finance side of this. So, when I think of the financing, I think, okay, I'm a $500 million bank looking to buy a $250 million asset operation, right? So I need $15 million. How how are banks thinking about that? What steps they have to take to get ready for that conversation?
Charlie, it's a good question. And I know many of your listeners well run banks, and they have good earnings and they probably have a war chest sitting around. So maybe this is hypothetical to a lot of them. I say that a bit in jest. I also want to say I'm glad we're visiting the buy side today. I think it's a very exciting time for potential buyers and sort of as a corollary sellers as well. But the activity has really picked up for a variety of reasons. We'll talk about it, but I think prices are increasing. And I was counting transactions that are on in various stages on my desk yesterday, and I counted 11. We always have, a few going on, but 11 is towards the high end. So there is activity out there. People are interested, people are excited. I think we saw that at Acquire or Be Acquired as well. And so getting into the specifics of your question, I thought another thing that's sort of interesting, I was reading a statistic, roughly 40% of boards discuss M&A quarterly and 28% discuss it annually. So if you do some math there, that equates to two-thirds of banks are discussing M&A regularly. So again, people are thinking about it and there's starting to be more and more that are crossing the threshold. So hopefully the context here will be helpful. In specific regard to financing, there are a number of options. I also should say part of the service and value that we bring is connecting you to the right team. If you're looking to engage in a transaction, it's important. And you mentioned self-promotion. I say this as a true fact. It's good to put a deal team together with the right accounting team, the right advisors, potentially an investment banker that really have connections and insight into all the aspects that we're going to be talking about today. And so again, you can get professional financial advisors to help you. But some of the options you'd talk about and that I would talk about with you as well are perhaps if you don't have cash on hand, you can look at a stock or a mixed stock and cash deal. That works really well. We see a lot of those. Obviously, if you're the buyer, you're going to get diluted. You should also think about how diluted you will be and what control the seller will have of your entity once the dust settles. But a stock or a mixed stock cash deal can be a great option. I've also seen capital raises. You got to decide whether you're doing a public offering or a private placement. In my experience, I do a lot of community banking deals. Again, in the Midwest, I usually see the private placement option. That works really well. However, it does take some time. You typically have to do additional documentation and process to go out and raise the money. And also, you usually have to have a contingency in your purchase agreement that says we're going to be able to raise the money by a certain date. So a seller is going to look at that, and if it's a competitive bid situation, they may prefer a more cash-like option over a capital raise. But still, all these options have pros and cons. Capital raises work well. Just to throw them out there, there's always the classic bank stock loan where you can pledge some shares for cash. You got to be careful because if the value of your shares change, maybe you'll violate a loan covenant. There can be things that happen like that. It is an option people use. Another one, just to throw it out there, seller financing, where you enter into some sort of agreement to pay over time. I've seen that done. It's fairly rare. The subordinated debt offering, again, subordinated debt counts as tier two capital. It can be a useful tool, but and there's no dilution to your shareholder base, which is great. But, sometimes we see a higher interest rate on that. There's probably still going to be loan covenants. You'll have to pay it back on a schedule. Another option that you can think about, I mentioned it sort of in jest at the beginning, but the classic war chest. Think about maybe wanting to make a move over the next period of time and start accumulating earnings so that even if you don't have the cash now, you will within a reasonable period of time. Again, if you have your strategic horizon that's 3 years or less, you can think we'll be in a position to use cash on hand at some point in the future. So
So,
those are, yeah,
yeah. So, Bo, let me ask a couple of follow ups there. In regard to cash on hand or a war chest, in that scenario, what you're just not offering a dividend or something like you're not paying them out somewhere, right? Is that how that typically works?
that's right. Assuming you have solid earnings, you may have been paying a dividend historically. Typically, if you're looking at buying, you're probably in a pretty sound position. So you would have to forgo the dividends for a while. That actually brings up an interesting point. As you develop your plans, you should communicate it to your board and some of your largest shareholders. If you're closely held, which again, a lot of my clients are, you can have those discussions as management and say, we'd like to make a move. We'd like you to forego your dividends, and we think, long-term investment that'll pay off for you. And again, many of my clients are kind of thinking 3 to 5 years. Where am I going to be? Are we going to be acquiring somebody? Might we be in a position to sell if the price was right? Or are we going to hold somewhere in between? And there's a lot of boards having that discussion. And the answer oftentimes is I'm not a buyer or a seller. It depends on the circumstances and the opportunity.
Okay. And so with those earnings, it's what typically a dividend, share buyback, or find another way to spend it, right? I mean, I guess you could keep it as retained earnings and let it.
That's
So
right.
in your scenario, you're talking about let's keep it as retained earnings. It'll be, and again, I understand retained earnings is different depending upon your corporate type, but we keep it in a war chest, have it ready, and then we go from there.
Exactly.
Gotcha. Okay. And then so let me just spend just a couple of seconds on the capital raise. The scenario that I always think about is I've got 10 major shareholders, right? And let's just call it, let's make the scenario real simple. There's 10% each. In the event that you need to do a capital raise, I'm assuming at some point you had some prospectus that said we did a capital raise in the past. So you got to get that updated and you say, I need another 15 million bucks. Charlie is one of the 10 has the option then of taking a higher percentage if I bring my 1.5 million to the table, or sit back, do nothing, and be diluted. Is that usually how that conversation goes? Or because we either need to go outside or we need everybody to re-ante. Is that how those conversations go?
That is right. And like everything, there's nuances to this. Of course, you got to look at your corporate documents. Sometimes they have what's called preemptive rights. That mean if you issue new shares of stock, everybody gets a bite at the apple, meaning all 10 year people get a chance to buy their pro rata share. Oftentimes, there's a shareholder agreement, again, in closely held companies that say, if we're going to issue additional shares, does anybody get a first bite at the apple? Those types of things. So this might be already taken care of in your corporate documents or in your shareholder agreement, but also it's sort of a decision because you're right. If you don't continue to buy shares in the capital rate offering or capital raise securities offering, you will get diluted. Meaning, if you owned 10%, you might now own 5, depending on how much you're raising.
Gotcha.
So yeah, all things to think about if you're going with that option.
Okay, but at a minimum, go look at your corporate docs and figure out. I'm sure most of these closely held operations, if you're a family member and you own a piece, you probably know what that document says as far as, whether there's a preemptive agreement or any option for you to buy in or be diluted. Typically, if you're a larger investor, you'll understand that, but it might not be a bad conversation to have with your board, a few years ahead of time. If
Yeah.
we're going down this path and we're going to either do a stock deal or we're going to do a cash deal, that's how this works, right? This is what this means to you as a shareholder. And if we go raise 15 million, that doesn't mean may or may not mean you get first shot at it if you want to reinvest or pro rata share or whatever.
Yep, those are the discussions that need to take place. What's required and what's permitted and what's our best course of action.
Okay. What last question on a capital raise, and this is just me being ignorant because I don't been through one, but you go do a capital raise and you raise $15 million or a potential for 15 million. Whoever decided to re-ante, right? Are they taking it out of their pocket and moving over to the bank? Or are they just agreeing to hold it in reserve until you need to spend the 15 million?
It would typically be you'd have an offering and people will sign a subscription agreement. And when you raise the amount of money you're looking for, the funds would be released to the corporation. So it's typically not a contingent funding agreement.
Okay.
You would typically actually buy securities, put in the cash. Of course, if you decide to do nothing for a while, you could ultimately dividend it out or move it in a different way. But yeah, you would typically contribute the cash whether or not you made the acquisition, and then the capital is sitting there.
Okay. Great. Okay. Excellent answer. Okay. So let's talk.
Yep.
Unless
Charlie,
unless we missed something on the acquisition side, or
Yeah, Charlie, I want to add one thing
oh
on
yeah, sorry,
the,
Kenny, go
the
ahead.
the stock piece. One of the significant advantages of doing a stock transaction is that in many cases it can be structured as a tax-free reorganization, and it allows the seller stockholders to continue their investment and not ultimately pay tax until they sell the new shares of the combined institution. And that can be a piece that really is attractive in a buyer's offer with respect to that. And it is a very common way of doing deals in the banking industry, using stock in a stock merger or kind of a mixed stock and cash that qualifies as that tax-free reorganization.
Okay, so help me. That's a great point. Help me understand how it would work otherwise if we go raise the cash. So let's just say the potential acquiree doesn't want your stock because they don't know how you run your bank, right? I mean, again,
Mm-hmm.
I'm sure that's
Right.
the conversation going on in the background if it's not in front of you, right? So I'm going to go sell my bank and I get stock, and now Bob's going to run my bank for me, right? Or control my shares or what have you.
Mm-hmm.
If it weren't that way and I want Bob to pay me cash, what are the tax? Are there tax? Is that a taxable event?
Yeah, so typically a seller, they're going to pay tax on the cash they receive as compared to the basis in their
Oh,
stock.
on the selling
And
side.
so if there's not enough stock in the transaction, then everything could be taxable. But if there's enough stock given to the selling shareholders, then the stock they receive isn't something they have to pay tax on immediately, ultimately when they sell it. And so they
I
are
see.
able to defer that tax impact.
Yeah, they don't have a capital gains event, something along those lines, right? Okay,
Right.
all right, okay, that makes sense. Okay, yeah, I think we covered that topic. If we need to revisit it, let me know. But I wanted to spend a couple minutes around price. Typically I always thought of price as some book ratio, right? Some ratio to what's on the books.
Yep.
That's probably dumbing it down away quite a bit. I would imagine that the book ratio changes depending upon size of the two banks, depends on, stock versus cash. It probably depends on a lot of things. So give me a
It,
feel for the factors that go into what you're willing to pay. And maybe it's just competitiveness, right? Maybe it's who's offering and how many potential bidders they have, but
yep.
just talk price to me a little bit.
Yeah, so you mentioned the book metric, which is multiple tangible common equity is the most common metric. It really is the starting point as you look at it, and that metric has been going up in recent years. In 2025, S&P Global mentioned that acquirers are paying a median of 150% of tangible common equity, at least through September. That compares to 131% in 2024 and 124% in 2023.
The term tangible common equity, I don't know that all of our listeners are going to understand that. That is basically assets on the book. Like, could you define? I could think of if I think of real estate, and your real estate's paid off, and the building's worth 150 grand. 150 is your common tangible equity, right? I
Hmm.
understand that it's all your
Yeah.
branches, et cetera. But what else falls into that?
Really,
Uh,
really, it's quite simple. It's the common equity on the balance sheet minus goodwill. So that doesn't count because it's not there to protect against deposits or protect deposits. And so it really is just that common equity number on the balance sheet minus the goodwill.
Okay, so if I'm a buyer and I think of the 1.5 ratio or the 1.3, I'm paying a 50% premium future earnings, sort of a price to multiple kind of or a price to earnings kind of a
Yeah,
scenario,
it's
or
that
goodwill.
multiple on that number, and anything over that common equity is gonna fall into goodwill on the pricing.
I see.
And
Okay.
and there are so many factors. Like I said, I mean, this really is a starting point. And what are buyers looking at when they're thinking about what multiple to pay? And a lot of buyers are looking first and foremost at the low cost deposits. What is the target's core deposit base? And could that be added on to the acquirers? They're also looking at geography of the target, where it's located. Does it complement the buyer's footprint? Does it fill in a gap that fits nicely? With respect to geography, a buyer may be looking at if the target's in a hard to capture area for growth organically, where it could be done in one step through an acquisition, or also if the target's in an area that's got attractive demographics that are growing that ultimately will be good for the business later on.
Okay.
Scale matters. Buyers are looking to oftentimes scale will allow for synergies or efficiencies across a broader platform. That scale may allow for investments in people or technology that otherwise couldn't be made, and it can also reduce risk across a broader platform and ultimately make the combined franchise more valuable. Buyers also look for durable earnings from a target that are consistent. So does the target have attractive return on assets or return on equity that's consistent over cycles and economic cycles, credit cycles? And are those earnings growing? That can affect the ultimate valuation and that multiple that's paid. Also, buyers are looking for niche areas. Does the target they're looking at stand out from the crowd? Are they doing something different that's growing, or would it add a new product line to the buyer that they would like to grow? All these factors can really affect that kind of starting point multiple on tangible common equity. There's issues too that can negatively affect price pretty dramatically. If there's either at the outset or through the process on a deal, if there's exam issues or unsatisfactory CRA ratings, if there's credit quality issues that are identified, or balance sheet items that are going to be impacted on purchase money accounting when the deal is closed. All of those can negatively affect. And then if there's any surprises in the diligence process, that can have a pretty big ultimate impact on the price that's paid. So sellers are wanting to put their best foot forward and limit those surprises. Buyers are weighing all of these factors and trying to figure out ultimately what they're willing to pay for this target. There are financial professionals, some investment bankers and accounting firms that buyers can lean on to help in making, specific purchase price that they're willing to pay.
Okay.
We'll be right back.
Ever feel like your tech budget's running the show instead of supporting it? You're not alone. Between bloated vendor contracts and outdated systems, a lot of banks are stuck paying more for less. And here's the kicker. Those big tech vendors, their contracts are built to protect them, not you. So if you're hesitating to make bold moves because of tech costs, it's time to flip the script. That's where Remedy Consulting comes in. We help banks take back control, cutting through the fine print, optimizing spend, and finding tech solutions that actually fuel growth. And we're offering a free review of your tech stack, spending, and vendor contracts. No pressure, no sales pitch, just expert insight to help you make smarter decisions. Even if we're not the right fit, you'll walk away with clarity and confidence. So go to remedyconsult.net or call 206-295-5776. Let's make your tech work for you, not against you. Thanks for listening to the BankTalk podcast.
No, that's a great analysis. So I'll ask you a harder question. Of all those things that you just described, right? When you're determining that you're going to pay, 1.25, 1.5 to tangible, which is the biggest reason? Is it because they think they can find more efficiencies? Like let's say they settle out all the one-offs, right? You look at your loan losses, you look at, I don't know, your technology contract and the fact you owe them $1 million, and you look at, I got this real estate isn't worth what you think it is. right? All those things, right? And now you've settled on
Mhm.
1.25. When I'm looking at a smaller, I'm a slightly larger bank. Look at a smaller bank in a location that's right down the street that I don't have access to. Is it efficiencies? Is it they think the 15 million they put up, they're going to get a good return on it? I mean, like what's the biggest driver? Your
Yeah,
opinion?
and there's no specific science to this, and each buyer is gonna be looking at different factors and weighing them differently. So you can't point to one necessarily. Obviously, an attractive core deposit base and really great and growing earnings are gonna have an impact on what a target's gonna get in a deal. But each buyer is gonna weigh the factors differently and apply it to what they're ultimately willing to pay.
Okay. All right. Because I think most of the ones that I talk to as CEOs, right, they say, I'm pretty sure I can run that one a little better than he has. And that might mean wiping out some staff, to your point of technology contracts, might mean, I don't know if it's always closing a branch because that's not really what they get into it for. But if I were looking for an overriding one, I would argue that they feel like they can run it more efficient. One in
Mhm.
this case is better than two separates, right?
Definitely a fair point.
Okay. Um, All right, so let's talk about, is there anything that banks can do when we talk about the efficiencies themselves, right? My question I always have is, can you pre-plan for the efficiencies you might gain, whether that be staff reductions, what have you? You mentioned quite a few things there, Kenny, on the types of efficiencies you might get out of combining, two banks into one. But what type of prep are you guys recommending to clients, for them to think about as it comes to, helping them become more efficient?
Yeah, and, you mentioned staffing reductions. I wanna be careful there. So, we'll come back to that, but that was a buzzword for me. I will say one of the best things you can do a few years out is network. You compete with some of your potential targets, but you're also good friends. I know you are. You go to events together, your peer groups together. You spend a lot of time together. So talk and know what they're thinking. Is somebody coming up on retirement? Is there somebody that's moved away and might be looking to sell through the next generation? Is the management coming up? Succession planning is huge and a huge point of emphasis by the regulators to do it, but also a lot of times there isn't a great answer on what's going to come next. So be aware of those things that's going on within your target market and your target area. Keep your ear to the ground and be ready for opportunity. So that's one of my biggest pointers. Another thing as far as synergies, what are you looking for? You may be thinking, and this does happen, I will say. I can't say it doesn't happen. But you might think, the management could be redundant or maybe in our view they're overly compensated, and if we combine, we can make some changes. But banking is a very specialized market and area and industry, and that expertise is very valuable, whether it's your loan officers or your back office people or your BSA AML staff. So a lot of times when you're making an acquisition, the people on the staff, in my view, are one of the biggest assets that you're going to be getting, and you should think of it that way. And you should plan on keeping a lot of the staff, and they're going to help you run your now new branches, your additional operations. They're going to know the customers, and so occasionally you can get some synergies from staff reductions. But in my experience, there's actually the inverse. There's a lot more time spent thinking about how do we retain the staff at least through the transition phase. And so that kind of brings up, you can start thinking about how do we retain staff. You can have short-term retention agreements. You can talk about who's going to pay for that with the seller because they're also usually interested in doing right by their employees. But again, think about what your needs will be because once you buy an additional location, you get bigger, you're going to need additional help. And this can be built into the transaction. This one though is in my experience a much better synergy, the technology. You know that you probably have a core processor and you have a contract with that core processor and it's probably a beast. And just as an aside, I would encourage you all to know the term remaining on your core processing agreement, and if there's any early termination penalties and what those penalties are, and discuss that as a board at least annually, if not more. A lot of those details are buried in a contract that's kind of set aside. So it's really good as a buyer, too, to know those details. But even more importantly, when you're looking to make an acquisition, you should think about, what kind of technology does the seller use? Who is their core processor? Is it the same as mine? If so, great. You can usually strike a deal with the vendor to combine and use them going forward. But a lot of times they don't match up. And so that does introduce variables into the transaction. Again, are there early termination fees? What year of the contract are we in? Are there deconversion fees? All those types of things can come up in a transaction and involve extra costs. And so then it's a matter of thinking about who's going to pay for them. And that's a matter of negotiation. I've seen that done all sorts of ways. And then how do we deal with this as a buyer after we close? A lot of the buyers I see try to get the conversion done on the date of closing, but keep in mind the core processors are typically asking for a 9 to 10-month advance notice after the purchase agreement is actually signed, meaning they won't schedule you until you have a signed agreement, and then it could be 9 months. Those times have gone up a bit. I hope they will come down, but I don't know. That's where we stand right now. And so if you have time, you should schedule that out. If you don't have time, you can continue to each run on your own system, but you have to reconcile that, and that's going to involve some manual work. So as a buyer, you should be aware of that. If you can't get a conversion scheduled, there are options, but it's going to involve extra work for your staff to reconcile and do reporting when you're using two different systems. The last thing I'd mention is I've heard this a few times, and it is so true. Don't acquire just to acquire because you think you have to, because you think you have to scale. Yes, scaling is important. Yes, it's good to grow in under a lot of circumstances, but think about a couple of alternative factors. As you get bigger, you're going to hit different compliance thresholds. When you cross a billion, it gets more complicated and continues to escalate from there. So be aware of those thresholds. Be aware of the additional work. And as an example, some of the banks that are commanding the highest premiums are under 10 billion in assets right now. So again, scale is a factor that may drive value, but it's not the only factor. As Kenny talked about with pricing, the value isn't necessarily there. So it kind of depends on how you look at these things. Sometimes it makes sense to scale, but be careful.
So when you start like the technology costs, of course, it's sort of where Remedy lives and dies a little bit. But one question I always had on that is when I think those technology costs should be obvious. Like I can't tell you how many times we've got clients or somebody we've never even met come to us and go, "Hey, could you give me a ballpark of what I'm going to pay?" I'm assuming that conversation is because they're negotiating. If the sales price is 15 million and the penalty to get out, right? Conversion, deconversion, early term fees, and all the rest of it, right? Is a million, right? Then the question is it still worth 15 or is it now worth $14 million, right? Depending upon who pays that bill and who's going to
Right.
take the risk on the bill, right? Is that the reason that conversation goes on around, what if I'm having somebody look this thing over and saying, I expect I got to fold one of these cores, they're going to go away. They're going to hit me with a penalty because they're going to give me a good kick on the way out the door because they're not going to deal with me anymore because now it'll be my contract doesn't exist anymore. That's generally, I'm assuming, accounted for when you're looking at the sales price, correct?
Yeah, it is. And it'll be accounted for one way or another in the agreement. Now, it depends on your leverage as a seller and as a buyer who's going to pay. The other thing I will say, you jogged my memory, the early termination penalty you said in your example, $1 million, and so it was 1 million off the 15. That's the right math, but it's the easy math. Keep in mind that a lot of times the early termination penalties are not $1 million. I sometimes wish we just knew. There's some sort of formula that says it's 85% of your highest month in the last 3 years times the number of months remaining and stand on your head. They're hard to understand. And so you basically have to ask, how much is the penalty? And then it becomes a negotiation because, again, the calculation may be difficult or may not make sense. And a lot of times it ends up being a negotiated number with your core processor. This is why, if you're a buyer and you use the same core processor as the seller, now you can step into the equation and exert some leverage over your continued vendor. And sometimes you can bring the million down that way. But yes, exactly right. The technology change has got to be accounted for in one way or another, and somebody is going to have to pay it one way or another. But it's a big point of negotiation.
Yeah, and I think what we always say, so I think we talked about this briefly, but we'll do those calculations for a customer, right, to give them an understanding of each side of the equation. If the buyer's paying, if the seller's paying, because they will have different terms in their contracts, right?
Yeah.
But what I always say is you know, the contract term does not run in it never ever lines up with when you're ready to sell, right? So you're thinking about a contract that goes 7 years out, and you might sell in the next 3-4 years, right? We always think that conversation is, should I just see if they can give me a shorter term contract and pay a little more versus take a longer one and pay those early term fees, right? So there's that, there's that conversation. And then the other one, if you think you're going to be an acquirer, you better have checked all the digits, not only in the contract, but in product and a bunch of other places, when it comes to just your tech strategy, right? If you think, hey, I'm going to buy somebody in 3 years, there's a lot of things in those contracts that would allow you to take that $1 million and say you'll absorb it, like going back to the 15 million and $14 million conversation, right? Maybe I buy you for 14 million, and if I can determine what your fees are in your contract, I can do it for $500,000, right? You may have saved yourself $500,000 there. If you're smart, your contract's a little better, and you have the same. Mostly it's when you have the same provider, right? Like
No.
it doesn't work too well if your provider's Jack Henry and their provider's FIS, and FIS is not generally does. In my experience has been they generally do not negotiate if you're just going out the door and you have nothing to give them,
Right.
because it's
That's
in
right.
that contract and it's theirs, right? Then there's no reason for them to give you a discount there. There is reason though to go argue those fees a little bit, because we have seen many times where the estimate of deconversion fees, conversion fees, and early term fees is early terms usually pretty easy to understand, but deconversion, and conversion fees, I mean, you need a doctorate in technology to understand what they're putting in front of you. So that one, in my opinion, is a bit negotiable. Somebody should look that over and say, am I, if you want, we use 1 million. I don't know if that's a good number, but you want $800,000. Are you sure? Are you sure that number shouldn't be 6? They're not going, if it's not contractually, they're not going to give you 6 for something to do. But if they screwed up on their math or overestimated something or whatever, there may be a couple $100,000 in there that you're being overcharged because you can't understand what they're putting in front of you.
I agree with all that. I also will say you did a nice sneak peek for our seller conversation. If you're a seller, we'll just do a sneak peek. Think about how long you want your technology contract to be, because like you said, typically they're going to be a little bit less expensive per year if you go a longer term. But if you do have a transaction come up and you're locked into a longer term, it's going to cost more to get out of. Also, for both buyers and sellers, do we really know where tech is going to be in 7 years? If you can save some that's always a good thing. But also think about, the world could look a lot different in 7 years.
Yeah, it's fair. Yep, absolutely. And I just think, I guess my point would be for either side of this, the cores are all pushing longer contracts, and whether or not you can negotiate them is all depends on how good a negotiator you probably are at the time. But yeah, a lot of moving parts, I suppose, in those areas. Okay, good. No, excellent. Is there anything else, as we talk about prep, right? Is there anything else from an efficiency perspective you can think of that, might make sense? I know I thought I saw in some of your material, there were some things along, go check the real estate, see, drive around their branches, make sure you know what you're getting your hands on, and those things are valued properly, and that kind of thing. But that's probably a low hanging fruit. Is there anything else that pops to mind?
On prep, that's right. Know what you're getting. Stop in. You can sometimes get a flavor for culture, employees, those types of things. But I think having the team, having the financing, having the strategic plan, knowing the opportunities, keeping your ear to the ground, that's going to go a long way. All the things we've talked about.
Okay, great. Okay, so Kenny, I think we had a brief conversation around what a buyer should be thinking about from a regulatory perspective, as they consider this. We kind of talked regulatory documentation. Can you hit some of those parts as well?
Yeah, for sure. So the transaction structure on a deal is going to dictate what regulatory approvals are required. Usually, the buyer's regulators are going to be the ones that receive the M&A application and are going to process. Regulators right now are really making an effort to move through applications more quickly, certainly more than during the Biden administration. The problematic principles based policy that the FDIC and regulators issued back in 2024 has been revoked in 2025. And so, really, what used to take, maybe not be allowed, or would take 1 year or more, has really kind of normalized down to even a 4 month review process. And we see a real change in the tone from the top from the regulators that's filtering down through day to day supervision and application processing. So, the regulatory piece really has shifted and normalized right now. Regulators are still going to look at competition in the process. So FDIC is going to ask questions about competition, including zip code, deposit analysis. The Fed uses Cassidy, and so which is publicly available to look at competitive issues. And buyers are going to need to prepare and do a pro forma financial of 3 years with projections. And so buyers are going to want to inform their financial professionals early, make sure that those are prepared and ready to go with the application as early as possible, so there's not a crunch after signing a transaction.
Oh, that's interesting. I never knew that was part of it. So they do a pro forma that says these combined operations, we think it looks like this, and then probably look at that as compared to degradation of capital or
Exactly, and the
stability
capital.
ratios, all that kind of stuff.
Exactly, and the pro forma capital ratios are all going to be really important in that regulatory review.
Okay, excellent. Good. No, that's good to know. Okay, well,
So
thanks, guys. Yeah, the I think this has been great. Is there anything we missed here? Anything we didn't talk about?
Yeah, I think quickly from my perspective, we didn't talk a lot about communications and confidentiality. And as a buyer, those are things you want to think about because if the deal gets out early, customers might wonder what's going on. Employees might wonder what's going on. You want to control the announcement. You know that the announcement must occur when you file the regulatory applications because there's public notice in the newspaper. So that's your last opportunity. Do you want a press release earlier? Do you want an employee meeting earlier? All things to think about. Also, keep in mind you're going to be doing due diligence. You're going to go and look at loan files. And I hope a lot of the sellers and buyers as well have made their loan files electronic so you can send them over. However, there's a fair number that still have not. And so then are you going to go in and do diligence on weekends? I've seen clients rent hotel rooms and bring all the files over. But you have to go to extraordinary means to maintain confidentiality. So you really do want to control the messaging. And so I guess that's another thing is be mindful of confidentiality and be mindful of your customers and employees.
Yeah, sure. The sensitivity around you looking over the files, and they don't know who you are, probably, right? If you're,
That's right. And even after you sign the agreement, we talked about it earlier, you're going to want to probably do a phase 1 environmental test. You're going to want to do a survey. And if you have these people sort of creeping around and the public announcement hasn't occurred yet, people could get suspicious and wonder what's going on. And so a lot of times the seller will ask the buyer, please don't send a surveyor until we've announced it. But at the same time, you have a time limit on the time that you can get the title work done or the survey done or the environmental done. And so sometimes that can cause problems. You can work through them all, but just it's good to have a plan before you go in.
yeah, that's great. Yeah, it's a subtlety, but it's a very important one. How about you, Kenny? Is there anything?
I would bring up that cultural alignment is something that buyers should really think about. The cultural integration of the two institutions can really often become the make or break factor in how the deal over the long term, if it's a success or not. And there really can be differences in risk tolerance and compliance in how loans are approved and the assertiveness, whether each institution wears ties or they don't. I've seen that become an issue. And this really is an important factor where the personnel can be one of the most important and valuable assets that are acquired in a deal. And if there is alignment, it can really help mitigate any issues that might come up. And then where it's really exciting is when it creates unexpected opportunities, even after the analysis on savings and synergies and all that, where there can be growth in certain areas that are unexpected. And that cultural alignment is a pretty key factor that buyers should think about as they're going through the process.
Yeah, that's great. Yep, absolutely. And again, probably another one that's overlooked. I just heard a story the other day of an organization that combined. It was almost a merger equals, but it was a couple years ago. And internally, they still can't get it together. Like
Mhm.
and again, this is hearing it a little bit from a third party, but just sort of the culture never merged, and it makes it more difficult to run the bank. And I think
Absolutely.
if everybody kind of sort of goes to the beat of a single drummer, it probably helps. Very good. Well, thank you guys. I really appreciate the time you spent with me today. Thank you for joining us on Bank Talk.
Thank
All
you,
right.
Charlie.
Thanks, Charlie.
Okay, that's it. Thanks for joining us on Bank Talk. Have a good day and keep on learning.
Thank you for listening to the Bank Talk podcast brought to you by Remedy Consulting. If you like what you hear, please rate, review, and share our work with others. Thanks again, and we'll see you next time.